I'm happy to see you.
Thank you.
Really nice.
It seems like it's been a little while, doesn't it?
It does.
I agree. What have you been up to?
Oh, just Christmas stuff. I
Good.
put up the Christmas lights yesterday and just, trying to get ready.
Yeah,
I'm a little late putting the lights up though, I think.
as long as they get up, right?
Yeah,
Whatever makes
exactly.
you happy. Okay. I am hopping into one of these old transactions just to pull up the document that we want. Sorry. So you're staying in town? Are you having a bunch of family come in?
Me?
Anybody? I'm just trying to make conversation while I pull up this document.
You focus on that or good.
We have quite a few people coming into town.
Do you?
How
Good.
many?
Yeah. We're hosting my side of the family for Christmas Day, and they'll come in Christmas or Eve. So we'll have a full house of people. And then we have Christmas Saturday at his family side and church in the middle of all that. So it's going to be a busy next few days.
Sounds
Plus, I
like
don't have
it.
all the Christmas gifts bought
Oh no.
or anything
Ooh.
wrapped. Oh my gosh. And the house is not clean, and I have not gone to the grocery store.
Oh no. Your house is, I feel like, always clean.
It's not right now, I can tell you that.
I feel like it is always
Well,
clean.
thank you.
Every time I've ever been there, it's like spotless.
Well, you're so nice.
Okay. I'm looking for any one of these transactions that has a third party finance addendum in it. Let me go back to
You could probably use Christine's Hidden Oaks one. There should have been a third party in that one.
Yeah, because it seems like everything I pulled up were listings, like right off the bat. I'm like, okay, this isn't helping me. Um, but nope, that one says upload. So see, all right, let me do that then. Hidden Oaks, right?
Uh-huh.
I would normally have this all pulled up before I got to you guys. So again, I apologize.
Okay.
Um, quite a few things have me a little bit off kilter today, but I'm here and I'm performing.
Is everything okay though?
Oh yeah, everything's good.
Everything's great.
I have a doctor's appointment at 6:30 this evening because it still hurts to swallow and I still have a headache and none of that went away. And the doctor said rest. I'm like,
Oh,
it's been long enough. I
You've
think
been sick
I've
for a
rested
while,
enough.
right?
Do what?
You've been sick for a while, haven't you?
It, I mean, it's just been like blah feeling.
Yeah,
I mean, that 1 week, I was like the week after Thanksgiving,
I remember.
I was just
Better.
out,
Yeah.
like literally slept for a week.
Oh. Well, it's good that you're going to a doctor then.
So well, yeah, last time I went, they were just like, oh, rest.
You know,
Doesn't seem to be getting it. Let's talk again.
let's revisit that.
So clearly, rest isn't going to fix this.
Didn't work.
Hopefully, she has something better to say than rest today.
yeah.
Fingers crossed.
We'll
Have you
see.
tried,
I got
Lori,
it.
have you tried the telehealth with NAR? I think it's NAR or
I
TAR.
haven't. Have you?
I have. Um, that was a lifesaver. They came out with that during the shutdown, and it used to be free for everybody. And now it's like, I feel like they bumped the price up to like $10 a month, but usually kids get sick at like 11 o'clock at night.
It's true.
So just like having to pay copays for hospital visits are not fun.
I know.
Um,
Yeah.
but like they're super fast. Like you usually only have to wait like 10 minutes to talk to somebody.
Nice. I might try that. No, I haven't messed around with it any at all. So it looks like Broker Mint is introducing mobile buyer offers, new release, manage offers on the go. I'll have to look into that. And that is nice. Okay, so you guys see my screen, the third party finance addendum. We're actually in a really good market for being able to negotiate all kinds of financing for our clients. So it looks like if you look at this one, it shows 8% on the interest rate. That has clearly gone down a good bit since this one was done. Okay, does anybody have specific questions that they want to make sure I address?
Yes.
Okay.
If you just briefly give like an overview of the different types of loans, like from the FHA to conventional and all that.
Perfect. Will do. Okay, well, and if anything comes up while I'm yakking, just unmute yourself and ask, because I'm gonna hide all of you guys and just look at the document, okay? Okay, so obviously we put the price or the property up there and then mark the type of financing that is going to be used, right? Conventional financing does have a product for an owner occupied, and typically for an owner occupied, it's a lower down payment. Conventional financing is conventionally used for interest or I'm sorry, investment properties. So anytime you have an investor, they're most likely going to be using a conventional loan. Conventional loans are what generally morph into a jumbo loan when you have anything over, I think right now it's over 780, it becomes a jumbo loan. It's been a little bit since I looked at that number, but that's what COVID did to us, because it used to be anything over 650, I think, prior to COVID. But with the increase of properties that we've had, or I'm sorry, property values, we saw the jumbo loan amount also increase. So typically that's where it starts, but conventional basically will morph into what lenders will call a jumbo loan. So the first mortgage loan and the second mortgage loan, sometimes a person will get a loan, say this one says 655. Say this person wanted to get a loan for 500 and then they wanted a second mortgage loan for 155 to cover the difference, right? Maybe they're getting interest rates are different. Maybe they want to pay one part of it off in 15 years rather than 30 years. So sometimes there may be times that there is a second mortgage. We may start seeing some of these come in as we do assumables. That's a totally different document that you fill out for assumed loans. Most of the time, if there is a second loan, the lender wants to hold both the first and the second so they can control them. If they are a second lien holder and the first one is foreclosed on, they are literally out in the cold not getting paid. So they want to most of the time control both loans, if that makes sense, so that they know what's going on with the first one. So you'll see that quite often. The percentage of the loan origination fee varies by lender. Most of the time, those loan origination charges are 1 or 2%. 2% is rather high. We don't see that very often. Occasionally, most of the time on a hard money loan, but most of the time it's going to be about 1%. But make sure that you're talking to your client's lender. Have a good relationship with your client's lender so that you can find out exactly how much they're putting down, how long that they want the loan to be for. In cases where we have buy downs, the amount of the percentage for the first, you might see where we've got 5% for the first year, and then after that it goes up right to the regular amount. Although there's 3-2-1 buy downs, that's not even going to fit on this document that we're looking at. The lender's going to have to come in with their own documents to provide that information to the seller. So anyway, if you have a 2-1 buy down, you would have for the first 2 years it's going to be this amount of interest rate, and then it would jump up for the remainder of the loan. Okay. Okay. So that's a conventional loan. A Texas veteran loan is only for Texas veterans. Even after my son he joined the military from South Carolina because he didn't want to be a Hollywood Marine. Anything this side of the Mississippi goes to California for training. So he used my brother's address to join the Marines because he wanted to go to Parris Island. However, as soon as he joined, he immediately changed his home of address, whatever they call it, to be Texas again, because Texas has the best loan program of any state. Most other states don't have their own veteran loan programs. As a matter of fact, Texas is the only one that I know of that does. There may be one out there, but Texas has the best loan programs, and they offer veterans a better product sometimes than even a VA loan. So if your client is using the Texas veteran loan program, again, know the lender, talk to the lender and find out what these amounts are. There is a Texas veteran loan, and then there is a Texas veteran land loan. The land loan is for 5 acres or more. This is just a veteran loan. So recognize the difference between the two of them. I see people all the time on the MLS accidentally marking that land loan. They think that they're marking the Texas veteran loan and they're marking the vet land. So make sure that whenever you're in the MLS that you're like noting the difference between the two of them. One of them is just 5 acres, it's land, 5 acres or more. The Texas veteran loan is going to require that the veterans sign a document saying that they will live in the home. I believe that it is for 2 years on the Texas veteran loan, and that could have changed. Last I heard, it was for 2 years. They have to sign a document, an affidavit at closing saying that they're going to occupy that home as their primary residence for 2 years. FHA insured financing goes up to about, Rebecca, help me here, is it 480 now? Or is it higher than that? Do you know? It is for, typically, it was invented for first-time home buyers. It has a very low down payment amount. The Texas veterans will have like a 0 down payment. The FHA has like 3.5% down payment. So it was designed for first-time home buyers. It was designed for your blue-collar worker that saved up some money and is trying to purchase a house. That is what FHA was designed for, years and years ago. And it is also for people, they have to sign an affidavit saying that they are going to occupy that home as their primary residence. Okay. Very much the same. This section part right here is going to be 203B or 203K. Your 203K is a rehab loan. Talk very closely with your lender if your client is moving into a home that maybe is not going to be FHA qualifiable because there's no carpet, there's just tack strip, like the carpet has been removed and there's just tack strip all the way around. FHA is not going to approve that. Probably still has glue on it. They're going to say, it's a trip hazard, and it's an incomplete floor. You can pull up that tack strip and redo that concrete to be concrete flooring, and now it is finished flooring, and FHA will accept it. So that's a little glitch, I think, in FHA. But completed finished flooring is one of the qualifiables for FHA. Having either a stove or a microwave is a qualifiable. Having a kitchen would be qualifiable for an FHA. So they qualify based on being able to live in the home. If something needs to be done, say the kitchen has been completely torn out and it needs to be refinished, the client can get a 203K loan, whereby it's still an FHA loan, but it's an FHA rehab, so that the lender has a certain amount, like the repairs can only be 20% of the after repair value of the home. Like, what would it sell for on the market once these repairs are done? So the lender is going to ask you about, the cost of the repairs and this, that, and the other. You'll have to provide estimates in order to get this loan through. These are not, a 203K is typically not a 30-day loan. Typically it takes 45 days to get that done because of the estimate piece, right? Providing those estimates, because they all have to be sent through underwriting as well. And then those vendors get paid directly from FHA. Then there's the regular 203B, which is what we see most often, especially with first-time home buyers. They have, only a minimal amount down. Sometimes we see the down payment assistance programs attached to the FHA loans because there are just a 3.5% down payments. The insured FHA insured loan of not less than this amount. This amount is going to be, so you've got a $300,000 offer and your client is putting down 3%. That's what, a $297,000 loan. You're going to put the actual loan amount in that blank. And then amortized over 30 years. Amortized is just what their payments are going to look like. If they amortize over 15 years, they could do that and double their payment, right? With the interest not to exceed what amount. When I'm filling in the interest amount, I like to protect my client. Stop and think about what we're looking at with a client. When you're looking at this from your seller's point of view, know what interest rates are going for. Know that knowledge. I mean, that's part of your job, is to know what interest rates are going for. There are some lenders that will send you a weekly, I've got one lender that will send me a daily update on what the interest rate is, and just glance at that and know what your interest rates are approximately, so that when you're looking at this for your seller and somebody has on there that as long as the interest rate is 5.5%, well, interest rates well enough to know that they're barely at 6% right now. So that's leaving your seller at risk for this buyer backing out because they've got the interest rate so low. Make sense? And then, of course, for your buyer, you want to buy them a little bit of movement in that, right? How comfortable are they willing to go? They maybe they are at a 5.5% because they have really great credit and they don't want to do a 6% loan, right? So there may be some negotiating back and forth between you and the seller's agent. If the seller's agent is savvy enough to notice and come back to you and say, wait, that's awful low. You may want to get them on the phone with your lender so that your lender can vouch for how strong this client is. And this client is actually qualified at 5.5%, and we're not seeing any issues with interest rates going up. You may have to do some coordinating and negotiating like that to get the best possible for your client, so that if it does exceed the 6% that your client's no longer comfortable with, your client now has a way to back out of this contract based on this paragraph because it exceeded what they were comfortable with. Within so many years, typically this is a 15 or a 30-year loan. And again, not to exceed what percentage is the origination costs. So that is going to be the same in most of these loan products. You'll see the origination, you'll see the interest rate, the number of years, etc. Know the difference between your 203B and your 203K. Have a conversation with your lender, you know, if you think that there may be some 203K going on. Sometimes this falls in, you know what, one thing that we're seeing right now, a good bit of is the roof. If a roof is not insurable, if it is past a certain lifespan and it's different for, if you listened in on our insurance agent that we had come in not long ago, she was explaining that different carriers, insurance carriers, have different life expectancies that they will go through, right? So some, after 10 years, they start chipping away at the percentage that they will pay. Like after half of the lifespan is gone, they'll only pay 50% of the cost of the new roof, or 70% if it's, you know, further down the road. So we have run into situations where the roof was at its lifespan. It was 18 years, it was a 20-year roof. My client in that situation actually thought she had a 30-year roof. But she works for an insurance company, and she said, I know that my insurance carrier would not cover this roof being that way. She chose to replace it for her client, but in some instances, if the buyer is, if replacing the roof is part of the buyer's cost and the seller's not coming down any more on the price, you can put the 203K in here and have that roof be part of the loan. Now that just means that your buyer is now mortgaging their roof, right? They are now going to have a 30-year payment on getting that roof fixed. But in some situations, that may be all that this person can afford to do. And if rolling that into their loan gets them their new roof and gets them their home that FHA would not otherwise approve, then that may be something to do. It's an option, right? It's about you being the expert and knowing all of the options so you can guide your client through, these are your options, and it's your choice which one you take. But knowing all of your options so that you don't have to miss out on the house that you want because, you know, the roof is at the end of its lifespan. So anyway, so that's one way that you could use that 203K FHA loan. And I hope I'm saying it right. I'm pretty sure the 203B is the regular and the 203K is the rehab loan. But if you talk to your client's lender and say, what about the FHA rehab loan? They're going to fill in that blank. They'll let you know what that blank looks like. Any of these blanks, you've got to have a conversation with the lender to fill in these blanks. So you've got to get to know them. A VA guaranteed financing, again, this is another 100% loan where the veteran is not bringing any money to the table at all. So it'll also be amortized over typically 30 years. With the interest rate being, you know, whatever, and they're typically good interest rates as well. They're very comparable to an FHA interest rate for the first how many years of the loan, right? Is that going to be 30 years? Is that going to be 1 year? And then it's going to jump up, you know, if we're doing the buy down. FHA and VA and USDA, the buyer cannot pay for their buy down. I believe on some conventional products, the buyer is allowed to pay for the buy down, but on these owner occupied, probably the conventional owner occupied option where it has only a 5% down, that probably would not allow the buyer to pay for their own buy down either. Those have to be paid by the seller. So know that going in. So the VA, again, that's for your veterans only. If you have a veteran and they haven't compared the Texas veteran and the VA guaranteed, have them do that. Have them talk to a lender that can give them both scenarios and what is going to be the best for them in their particular situation. Because they are very close. Those two products are very close, but sometimes the interest rate or the fees kind of fluctuate a little bit. So, this month the VA could be a better choice. But next month the VA, the Texas Veterans could be a better choice. So you never know. So make sure that your client they know that the option is there for them and they're having that conversation. Their home of record has to be Texas in order to use the Texas Veteran. Just because they retired and they moved to Texas does not mean that they get to use the Texas Veteran. They have to have their home of record be Texas when they are enlisted in order for them to have taken advantage of the Texas Veteran. So again, if you're talking to other veterans that are still in the service, and they don't have Texas as their home of record, but they're wanting to buy a home here, you might suggest that they look at changing their home of record so that they can take advantage of the Texas Veterans, if that's a better deal for them. USDA guaranteed, also another 100% loan, has the same exact blanks to fill out. The USDA guaranteed financing was initially created for farmers, to be able to purchase additional land to build on or farm or whatever. So there's not as much of a requirement for a home to be on the property with the USDA loan. A person can many times purchase just land with this loan. There's generally not sure how that goes. There's
Is that what you
always
use, like, for
loan,
ag exemptions?
yeah, land products have always been a better option. When it's just blank land than USDA ever was, but that was initially the intention of this. Now we have so many land products that are better deals for people that are wanting to buy just land. People don't use this USDA product hardly at all for land, but there used to be 5 or so years ago, there was still a product where somebody could do that. And then you mentioned something just now, Michael. I wanted to touch on that.
Yeah, the ag exemption, is that what you would use for that?
So no, ag exemption is on land when someone is using it, say, for beekeeping and it has to be 5 acres or more. It could be for beekeeping. It could be for if they have an extra large garden and they go down to the farmer's market and sell it. They would have to, provide certain documentation to the county in order to get that ag exemption. And then most of the time around our area, we see the ag exemption being used for cattle. I don't believe that the ag exemption can be used for horses, because I think that was the reason that my stepdad made sure he had goats on his land with the horses so that he could get his ag exemption. But I don't believe that horses are enough to get ag exemption because those are not food products in the US. And USDA is about, feeding people kind of thing. Farming, right? Having chickens can also be an ag exempt thing. You have to have a certain number, right, per acre in order to get your ag exemption. So that's what an ag exemption is. The USDA is many times, I would say 90% of the time that we actually see USDA being used is small towns and 100% financing. Gerald in our area is still considered a USDA area. I would have to have Renee on the line with me, Michael, to confirm for your area. I'm going to guess that Seguin is probably a USDA qualifiable area. And you can go to usdqualified.gov, I think is what the site is. If you just look up USDA qualified properties, you're going to find a site where you can type in an address and it will let you know yes or no, this is USDA qualifiable or not. But I bet Seguin is USDA. New Braunfels and San Marcos may not be. So, but this is a loan product for more rural areas that allows for 100% financing. Based on the assumption that people in more urban areas have probably, a better access to higher paying jobs. So that's kind of the thoughts behind the way that this is laid out. And then whether you're in those smaller towns, you're probably making less money. So so there's this USDA guaranteed financing option with 0% down. Any questions on that? Any questions on anything so far? The reverse mortgage, we used to hear all the time, this was a bad option, it was a bad idea. We are hearing now more and more that this loan product has changed a great deal and may be a good option for some. There are options for a person over a certain age to be able to maybe sell their home and put that money toward a new home and then have this reverse mortgage happening where the equity from that home is paying that. So, and then you have the option for that to be insured, which you'll notice that very last paragraph, that loan can be insured by FHA or not. This is really good in a situation where there's a great deal of equity in a home, and which now we're seeing a reduced amount of equity based on the market settling. So sometimes this doesn't always play out well, but our previous market, there were so many of these reverse mortgages happening. So many of our lenders were doing these reverse mortgages because the equity had skyrocketed. So people had the opportunity to do that and let their equity pay them. This is not a good idea for someone who intends to pass their home down, whether through their will or through a trust or anything like that. This is not a good idea for those people. But for someone who their children are just going to end up selling their home, this is a great idea. That mortgage would then get paid back when the home is sold. The children get a bit less of a cut, but this is someone who is looking out for themselves more, or maybe they don't even have children to pass things down to. So this is someone that is not concerned about whether or not their children are going to be able to take advantage of any equity in that home when they pass. Clear as mud on that one. And any lender that does reverse mortgages is definitely the one to talk to if you feel like you have a client that may be in one of those situations that this might potentially be a good possibility. I had a client like that last year, and they sat down and talked to the lender. They ended up not going with the reverse mortgage, but they did sit down and talk to the lender and take it into consideration. I gave her, this is what it, this is when it is good to do those types of things, and you definitely should ask your lender about it. And of course, they had that conversation, but decided to go against it. As long as we're providing all of the options to our clients, we're not making these decisions, we're providing them with all of their options so they can make those decisions. Okay, other financing. This is where, especially during that craziness in 20 and 21, we were initially seeing a lot of cash offers come in that were actually hard money loans. Hard money loan is someone who has the portfolio where they are able to buy the home in cash, and for the buyer, right, or provide that buyer the money. It's typically a single person. It is not an institution, a lending institution of any sort. It is generally a person or a small LLC that is owned, that they will lend the money to the buyer. The buyer will then be able to purchase cash. And they can get this done typically within a couple of weeks. So just like a cash buyer, they can get it done very quickly. But most of the time, this comes with a much higher interest rate. And I mean, much higher interest rate. And then it's only good for, generally it's less than a year. I see that this says, it got the word years there. Most of the time, these are payable within 6 to 9 months. It just gives the buyer enough time to get into the home and then actually do an equity loan, right? Kind of refinance and do an equity loan to pay off the initial loan and now have a regular mortgage rate instead of this excruciatingly high interest rate. And when I say excruciatingly high, I mean they can be 12 to 15%. They are not cheap loans, but it was giving buyers an option to purchase a home and compete against cash offers back in 20 and 21. Nowadays, the type of thing we would see this used for is a buyer who cannot otherwise be approved. Maybe they are cash heavy, we say cash rich and credit poor, so they're not able to qualify. Maybe it's a self-employed person. Think of all of the homes that we sell as agents. A first-year agent who hasn't been doing it very long but had a really fabulous year might have enough money to put a large amount down and might have enough money coming in to maintain financing, but they're not able to get approved with traditional financing because they've only been in business for themselves for 1 year, right? Whatever that might look like. It could be that their credit is low. It could be that they, for one reason or another, are just not able to get approved under traditional financing, but yet they have a large sum of cash, which is what these hard money lenders typically require. So other financing are just these very creative financing products where someone might offer to carry the note for another person. It might be a small LLC that is a partnership of 3 or 4 people. These are many times called REI, real estate investment portfolios, right? They're real estate investment partnerships, a REIT. So they are typically maybe a group of people that have pooled their money in order to be able to provide this service. So they're not generally held to the same guidelines and requirements of many of those government-backed mortgages. They're also not held to any of the guidelines of federal requirements, which can be a little bit of a danger for a client looking for this. A little bit more risky for a client that is looking at doing this. So typically, if your client is looking at some other form of financing, you want to help them see that this is more expensive and much riskier, so that they can see the importance then of very quickly getting themselves in a position for a traditional loan, so that they're not paying exorbitant interest rates or whatever. Origination charges on these loans tend to exceed that 2% that we talked about earlier. And then the buyer also on this other financing has the right here to waive the right to terminate based on paragraph 2B, which has to do with the approval of the home for financing. So under this other financing, the buyer gets that option. If you worked any at all with the what do we call that? The appraisal waiver is what we were calling it. That is not the name of the document. But during 20 and 21, we were seeing many people waive their right to terminate, that's what it's called, waive their right to terminate based on the appraisal. So if the appraisal came in higher than their loan, or higher than the mortgage company was willing to loan on, the buyer was then required to pay that difference if they check that box that says does or does not. If the buyer does waive all rights to terminate, then they would have to bring the money to the table, right? So in that paragraph, it gives that option also for this other financing, because many times going to have a more difficult time appraising because probably they're paying a higher price with this type of financing. Approval of financing is separate from approval of the property, and that is mentioned here. It's pointed out here. Buyer approval, property approval are two separate things, right? For buyer approval, we're often seeing 21 days in here. The most lenders don't need 21 days. So when I'm on the seller side, I push hard to get this number as low as possible, so that if, God forbid, anything happened with the buyer where they decided to go put a bunch of furniture for their new house on credit, they would not be able to get out of this contract because they have to notify within, I like it to be 7 days. If I talk to the lender and I can get 7 days out of the lender, oh yes, we've already approved all of their stuff. You know, we have verified their income, we have verified their credit and their expenses. We've got all this stuff verified. We've seen the documentation ourselves, we verified it. Or some of them will even say, oh yes, we've already put them through underwriting, they're ready to go. Well, then why, we don't need 21 days to approve that buyer. We are seeing 21 days as very common, but no, whenever you're representing the seller, talk to the lender, and do your best to negotiate this down as low as possible. The lowest I have been able to get a buyer's agent to reduce this lately has been 10 to 14 days. Because they're saying 21 days is customary. Well, yeah, but you don't need it. It might be customary, but you don't actually need it, because I've already talked to your lender. Your buyer's in a great spot right now. And I don't want to give them 3 weeks to decide what furniture they want and then go charge off a bunch of furniture. And now my seller is not going to get the earnest money because your buyer made a stupid move, right? So I do my best to talk that down as low as, I always start with 7 days. If they're already through approval, I might even start with 5 days, but I always try to get that down as low as I can. So there's both sides of that story, but yes, 21 days is what we're seeing most often. It is currently customary, but unnecessary. So negotiate for your sellers and negotiate. You have to negotiate hard for that, but you have to talk to the lender and get hard, cold facts from the lender. This is how long it's going to take them. They've already been through whatever. I've already talked to your lender. I already know that they have approved this person. The only thing we're waiting on is property approval, which is completely and totally separate from buyer approval. Property approval is when the appraiser goes out and determines if the home is worth the amount that the buyer has offered. For the mortgage company, so that the mortgage company knows that they are getting their value from this loan that they're providing. Typically, if my client, the buyer client, is not completely convinced about, or sometimes even me, if I'm suspecting that there may be some repairs that come up that the seller's not willing to do and the buyer is not willing to live with, I might tell the lender, hey, let's hold off on that appraisal. Let's wait until after we have the inspection done and we're comfortable with the inspection, and then we can send the appraiser in. So many times, I have done that in the past. So, just know that the appraiser can go in after the inspection. Now, if you are, if you and your buyer are really, really comfortable and you're pretty confident that this house is going to appraise and the inspection is going to turn out great, then it's perfectly fine to send the appraiser in before the day after your inspection. I mean, it's perfectly fine to get that appraisal done ASAP so that you can close sooner. If that's in your buyer's best interest, weigh it all out, let your buyer know their options, and then do your best to, to coordinate that for them. They many times have to pay a separate fee for the appraisal. So I'm trying to save them that extra money of paying for that appraisal if their inspection is not going to, or the repair amendment, amendment is not going to be, if that negotiation is not going to go in their favor and they're not going to be willing to continue. Okay. Financing has to be secured by a vendor's lien, typically. That's what the security is. And then FHA and VA required provisions. Believe USDA has one of these too. Maybe they're putting that underneath HUD and VA and FHA. But this is the paragraph that says if the property doesn't appraise, the buyer is not required to purchase the property. And this appraisal number, the number that you're going to put in for, is going to be the amount that you're offering, right? The contract price. So you're going to put that number in here. Now, again, many times especially during the craziness, we were putting in here a number higher for that or the contract price, right? Excuse me, guys. Did you get all of them done? Mm-hmm. All three of them?
Yeah. It's kind of hard to find them. So
Show Miss Myra and make sure she's okay with that. Thank you. That's fine. Just show it to her, make sure she's okay with the way it looks. Sorry about that, guys. I've got my grandson here helping up with some property management stuff. Okay, any questions on any of this? Okay. So that's what this whole paragraph covers, is the fact that that the FHA or VA buyer is not required to purchase if it doesn't appraise. The waiver of appraisal that we were using was not even allowed to be used for FHA and VA buyers. So that's why we weren't seeing too many of them during that time. This is the authorization. Number 5 is the authorization for the information for the title company to provide information to the seller and the seller's agent, the buyer and the buyer's agent, regarding the closing and settlement statements. This is what allows the title company to be able to give us a settlement statement that discloses, how much the buyer paid and how much the seller made and all of that stuff. So this is the document they added. It used to be a separate document. They've added it onto the third party finance addendum for us. So unfortunately, that just means that when it's a cash deal, we don't have the authorization to get many times the settlement statement. So that can mess us up a little bit. And we have to go through other routes to make sure that we get a copy of that, because the Texas Real Estate Commission requires that me as the broker for me to keep a copy of a closing disclosure that shows the amount that Classic Realty was paid with our client's signature on it. So sometimes we have to get it from them if it's a cash deal. Okay. Yeah, there you have it. That is the seller's disclosure in a nutshell, if that was a nutshell. There are additional, I said seller's disclosure, it was not seller's disclosure. A little bit of a fuzzy brain. I still have that headache. I told y'all that. That is the third party finance addendum. There is also a seller finance addendum. So if a home is 100% owned and the seller is financing it, we would use the seller finance addendum. And then there's also the assumption addendum for a loan being assumed. A loan being assumed, it has a lot more information that we would have to get from the regarding the current loan in order to put on that document. The seller financing, if your buyer is looking at something for seller financing, most savvy sellers agents who have a seller finance available, they are putting in the documents section of the MLS information as to what the seller is going to require for the loan, right? How much they want down, how much they're willing to do for the interest rate, all of that stuff. If you come across situations like that, reach out to me, reach out to your mentor or whomever, and get some guidance on how to do those. If the seller, I want to be very clear on this, if the seller still owes on their mortgage and they are doing a seller finance, that is not a seller finance in its true form. That is called a wrap. They are wrapping the difference of their mortgage with the new payment. It can be done. There are ways to do it to protect your buyer, to protect your seller, using a service company that takes care of that loan. It can be done. We can do them safely, but just know that if anybody tells you, oh, it's seller finance, the seller still has a mortgage, that's not a seller finance in its truest form. That is a wrap.
Isn't it more of like a loan assumption?
No,
No,
it
okay.
is not even a loan assumption. A loan assumption, the new buyer has to be approved by the current mortgage.
Okay.
Wrap, the buyer is not getting approved.
Okay.
And there's a lot of different caveats. It can be done as long as buyer and seller both understand the risk that they're taking going in. It can sometimes be a good option in certain situations.
Okay.
So, but call it what it is. It is not seller financing. It is a wrap, and our clients need to know the difference. So if you come across that situation, call me. Call your mentor, whoever. There are agents that absolutely won't touch wraps. Let me tell you what happens to those clients. They go find an agent that will. Be the agent that will. Don't let your money walk out your front door. Just make sure they understand their risk. Okay? All right. And I think Mackenzie is also having a training right now on the web. Think maybe that's for admins. Maybe that's just Rebecca and Evan. I think that's admin training for the new website.
Thank you, Lori.
So, all right, there it is.
Better.
And we've recorded this so we can send it out to our other agents as well, the ones that weren't able to make it. It's Christmas week. Thank you, Michael, for being here, taking time out of your busy day. Christine, we appreciate you guys being here.
Thank you.
Michael, it was good to see your face too. Christine, I hope you have a good Christmas.
Thank you, you too, Lori.
All righty, take care. Bye, everybody.
Bye.
All right, bye.
Bye, Rebecca.